House prices slip in half of U.S. cities. Prices are down in 147 of 287 cities. Government data crunchers find. A major government housing study today confirmed what has become more obvious by the day. House prices are sinking, and in some areas sinking fast. Home values in Ann Arbor, Michigan fell 5.7% in the third quarter alone, along with prices in 146 other metro areas. And year over year, prices fell in 83 of the 287 cities covered. By data released by the Office of Federal Housing Enterprise Oversight for the quarter ending September 30th. The data underlined a drumbeat of dismal housing headlines this week. Realty Track, which collects data on foreclosures, today reported a 94% year-over-year increase in foreclosure filings for October. There is now a default notice, auction sale notice, or bank repossession for 1 in every 555 U.S. households. The respective gauge of home prices, the 20-city S&P Case-Shiller Index reported Tuesday that home prices fell 4.5% in the third quarter compared with the previous year, the fastest drop in the index's 20-year history. Sales of existing homes, the largest share of the real estate market, fell for the 8th straight month by 1.2% since September and 20.7% since this time last year, the National Association of Realtors reported Wednesday. It said prices had declined 5.1% over the same period. Global Insight, a Boston area economic analysis firm, predicts the foreclosure crisis will have profound economic effects in 2008, including at least a $1.2 trillion loss in home values and at least 1.4 million new foreclosures. The Calculated Risk blog quotes Goldman Sachs analysis predicting a substantial drop in home values nationally, about 15%, with possible losses in Florida of 30%. If a recession happens, prices could fall by 30% across the country, the report says. Stubborn trouble predicted. The big question is whether you're buying, selling, or simply watching from the sidelines. How much longer will all this go on? Experts polled offered little hope of a quick turnaround. Joshua Shapiro, chief U.S. economist for the economic analysis firm MFR, predicts the crash is probably a multi-year event that began in mid-2006. We will be watching inventory data and surveys of lending conditions to try to gauge the bottom. But this is not going to be reached for many quarters. George Washington University economist Richard Green says predicting the turnaround is difficult because people's expectations play such a big role. So much of how things are going to look in the next couple of years is a function of expectations. He says adding that the psychology of the market is pretty bad right now, and it could get worse. There could possibly be a recession next year. Very possible. Economist James Hamilton at the University of California, San Diego, expects price declines, perhaps substantial, in most markets over the next year. Until the problems in the secondary mortgage market become resolved, I do not see significant improvements coming. Economist Ian Shepardson, chief U.S. economist at High Frequency Economics Analysis, told readers of the firm's newsletter that the rate of decline is accelerating alarmingly. Home values could fall by 30% nationally before the slump ends, according to Joseph E. Huston, president and CEO of Shore Bank. It will be at least a year, if not more, before we see signs of a market recovery, said Huston through a spokesman. He'll need evidence of a steady increase in home buying before believing the worst is over. It could get worse, much worse. There could be a recession by next year. Perhaps a depression not long after that. Nope, it doesn't look too good for the economy. Another sign of the last days, and yes, there are many of them, multitudes of them,